Okay, 11 o'clock. So let's get going. The guest this week is Stephen Rosser from Next Energy Solar Fund. So we'll be talking to him in a minute. But first, as usual, I've got a bit of news to have a look at. Actually, a quieter week this week, and it might, I think, because people are sort of slightly shell shocked by what's going on in markets. But Polycap Financials came out today with some news about its planned reorganisation, and we'll talk about that. And then I just wanted to have a look at what has been going on since Trump announced the tariffs. So Polycap Financials first. Well, as you can see, it's not too bad a chart. This is a 5-year chart, and this is quite relevant because basically every 5 years now, it offers investors the chance to cash in their investment at asset value. And you can see that that helps keep the discount relatively tight. And you can see that the discount has been trending in really for well over a year now in anticipation of this. It's quite a sort of good move, I think. And also, as we've talked about a couple of times recently, this idea that you can get out, but you only get out sort of once in a kind of market cycle, I think is the ideal way of doing these things, because then investors can actually sort of sit back and think, this is how it worked over the last cycle. Do I want to run it for another one? And I think that's a far better way of doing it than doing it every year when you get this sort of situation where people go, oh, this is good. I can use this cash, so kind of like a cash machine. So, decent sized fund, £560 million. And I'm hoping that it won't shrink too much, but we'll see what happens, and it may even grow. But obviously we're in slightly strange times. In terms of doing the job, it has beaten its benchmark over the period since the last tender. These are numbers from its website to the end of February. And you can see it's just ahead. It would have been a lot further ahead, but some of the gyrations that have been going on recently, it's been quite hard to keep pace. I do think this is a decent set of managers in this sector, and really part of the whole argument for it is that it's a subcontract for what is a quite complicated sector to get your head around. It's obviously a global fund, and again, part of the attraction when it was first launched was that there's a quite limited pool of big financial stocks to invest in the UK. And so if you got money here and you want to get a more diversified exposure, you have to go overseas. If you're going overseas, you're going into all sorts of regimes, and just opens you up into far more different sectors. So it's quite a complex beast. And this is why you need a pool of expert managers actually managing the money for you. And you can see here, this is the end of February. Banks didn't make up the majority of the portfolio at the end of February. That is a change. It's a deliberate change that the managers made relatively recently. And you can read more about it in our notes. So what they've published today is that, I've put the 10th of, sorry, it was yesterday. They're going to publish a shareholder circular sometime before the end of May to basically cover all the votes off that needed to get this done. So there's a 100% tender offer. It'll come at about a 1% discount to NAV, but that's not. But basically, it's letting you get out at net asset value less costs, and that will all be wrapped up by the end of June. And at the same time, if people want to come in, that would be great, and they'll be able to expand it as well. So, as I said, all a good move. There is a minimum size threshold. So if it did turn out that everybody ran for the exit, then and it turned out to be far too small, then they wouldn't keep it going, which is obviously quite sensible. There will be another one in 2030, and they're going to stick with the same investment approach that they've been using for the past 5 years, which has obviously worked. So in terms of what they are changing the fee, and that's coming down. So there's a new tiered fee. So assuming it does grow to stays above 500 million, then the sort of second tier now kicks in, so 0.65 on the balance. But more importantly, the way that it's calculated won't be just on NAV now. It'll be half on NAV and half on the layer of market cap and NAV. So that assuming that it tends to trade at a discount, will bring the fee down. And the other thing that a lot of people, I don't mind performance fees. Some people have a problem with it. They are just getting rid of the performance fee. So that obviously makes the whole thing slightly more straightforward. And then the other big change is an enhanced dividend policy. And they announced this a little while ago, but they're just confirming it today. they're going to pay 1% of the NAV out each quarter. So in the end, about 4% of NAV per annum. And that seems to be that sort of typical figure for these sorts of things. They were paying semi-annual dividends. So basically it becomes much more of an income stock. And financials actually is not a bad income generating sector. You get some decent dividends off these things. And so I think this does kind of make sense. You won't get the first of these until I think early 2026, though, because it kicks in with the new financial year. So that was Pocket Financials. Now, I just, as I said, wanted to have a look at what Trump has done to markets. So first off, this is some numbers for individual markets. So you can see there the hardest hit things are paying Argentina, Vietnam, China, and then some odd ones you might not expect, like Norway and Denmark. And I think that's because they've got a lot of energy. We'll see that in a second here. But included in this list are US small caps, the Russell 2000. So obviously that's hitting his own base. And also UK value stocks, which is slightly weird. But I think that, again, that might be because of the oil effect. And you can see that here, if you look at the first three sectors, this is looking at the global index, the All Countries World Index, and looking at the individual sectors within it. These are the hardest hit sectors. So energy equipment, energy itself, oil and gas are the three worst performing things. And the oil prices come right down on the back of this. And this is all on the back of an expectation that the global economy will slow down and there just won't be as much demand for energy or for oil on the back of this. We've got the ongoing hit to tech, which has come out of things like DeepSeek, but just a sell-off in the Magnificent Seven, that's a bit too. An obvious thing for trade is the air freight logistics, so that's come off too. But also, again, on the sort of global demand thing, you've got resources coming off commodities. And then the sectors that have been hit hardest since he came into power have been biotech and pharma. And I do think there are starting to be some bargains in that kind of sector now. But obviously that's not directly related to what he's done with tariffs. And then if we look at the sectors that have been affected within our market, you can see here that you've got China and Vietnam selling off. So country specialist is really just Vietnam, and it's got one Korean fund in it. And they've been some of the worst affected trusts. But again, North American small cap, which is probably not what you intended to do. You've got a knock-on of China and Vietnam on Asia Pacific. The increased risk around things has caused a sell-off in growth capital stocks. Obviously, things that are related to early stage companies trying to grow, which could be more difficult in a slowing economy, but I don't necessarily think it will be, because sometimes these are in new industries that will grow regardless. Actually, it's slightly counterintuitive because you've seen some odd moves in bond yields, but there's been nothing obvious that say that rising interest rates will have an effect here, other than perhaps people thinking that there's a long-term inflation problem now. And that means rates will stay high for longer, but we'll just have to wait and see on that. And then some of the other ones we've talked about already. Environmental, a bit like pharma and biotech, is another thing that's just been selling off since Trump came into power. And again, I do think the stocks in here are quite cheap. We were talking to Impacts yesterday, and they were saying, a lot of their portfolio is looking relatively undervalued now. And then in terms of the individual trust moves, it's kind of the sort of things you'd expect to start off with. So Fidelity, China, International Biotech on the back of this pharma thing, and biotech growth there too. All the China funds, basically. Vietnam Holding, Vietnam Enterprise. It's very unfortunate Vietnam Holding. They're actually trying to compete with me doing a seminar now. Obviously, I'm hoping you're watching this rather than them, but either way, you can catch us on catch up. So I would suggest maybe you go back and have a look at that one on catch up if you're watching this live, or vice versa. Slightly odd one in there is Hansa, but the discount on that has just got ridiculous. But there's nothing that anyone can do about it because the family that controls the company just don't seem to be bothered by the share price. And then reflecting this value sell-off, you've got the Aberforth geared value and income in there as well. So I thought this is interesting. There's not much to conclude from that other than perhaps where you might find some bargains. And these are the widening discounts. And this was a slightly odd surprise to me because it wasn't in the China things, the Vietnam things, the pharma stuff. It's a different set of stocks. Now, one of the things that seems to be happening as a result of all of this is that the IPO market shut down again. And obviously we were hoping that things like Klarna was basically about to start marketing an IPO and pulled it at the last minute. So that will all get delayed now. So that could make it harder for private equity companies to get exits. And that could mean that you don't get the NAV uplifts because the NAV uplifts tend to come when they get the exits and less on the back of what's going on in the economy. So you've actually got quite a lot of private equity funds widening out here. Those discounts were already too wide anyway. I think this is an overreaction, but nevertheless, that does sort of explain why you've got ICG Enterprise, Digital Capital, Apex, as well as Harvest in that list. And it kind of goes for Peters Hill too, because that's in unquoted asset management companies. And obviously they've got the geared effect then on the asset management companies of moves in markets too, so their AUM is going down. Then you've got the growth capital ones, and I say these don't really make sense to me. So Seraphim and Hydrogen One, again, they were cheap already. I don't think there's any real justification for why they've sold off. So they may be interesting. Digital 9, we know it's a basket case anyway. It doesn't really make sense to me either. It was trading higher in anticipation of it getting the tax credit money from its new batteries that have come online in the States, so California and Big Rock and Dogfish in Texas. I still think that money's coming. There's been nothing to say that isn't coming, but we'll just have to wait and see. There is a risk around that. So maybe some interesting things to think about there. Definitely in the private equity space, I think there may be some bargains, but there we go. So that's enough from me.